Pinterest's shares surged by 4.8% following an upgrade from Morgan Stanley, which raised its rating from equal weight to overweight and increased the price target from $37 to $45 per share, indicating a potential 21% upside. This positive outlook is driven by Pinterest's strategic investments in GPU technology and generative AI, which are beginning to show promising results in enhancing user engagement and monetization. Morgan Stanley analyst Brian Novak highlighted these technological advancements as key factors that could lead to a re-acceleration of Pinterest's revenue growth, projecting a 17% to 18% increase in the latter half of 2025, surpassing current market expectations. The upgrade reflects growing optimism in the analyst community, with 32 out of 41 analysts rating Pinterest as a buy or strong buy, according to LSEG data. As Pinterest prepares to release its Q2 earnings on August 7th, investors are keen to see if the company's AI strategy is effectively translating into improved financial performance. The focus on GPU and AI-driven initiatives positions Pinterest alongside other tech firms expected to benefit from advancements in AI, potentially granting it a competitive edge in digital advertising and user experience. The market will closely watch the upcoming earnings report to assess whether the anticipated revenue acceleration is materializing, potentially driving further stock appreciation.
BDO's recent report, Tectonic States 2025, The New Business Edge, highlights resilience as a critical priority among global business leaders, with 61% acknowledging its importance in navigating uncertainty and disruption. The report surveyed 1,050 executives from mid-sized to large enterprises across various sectors, revealing a strategic focus on artificial intelligence, AI, and data infrastructure to mitigate risks and maintain a competitive edge. The findings emphasize the necessity for businesses to prepare for multiple potential outcomes, with 73% of executives advocating for future readiness. However, almost half of the respondents expressed concerns about their organization's current capabilities to handle market disruptions effectively. The report also sheds light on the challenges of balancing innovation with protection, as cyber risks and outdated infrastructure pose significant threats. Notably, 45% of leaders cite data security concerns as a barrier to further AI investment, while 42% worry about keeping pace with technological advancements. The emphasis on data management as a strategic priority underscores the need for robust infrastructures to harness technology benefits. This report, the first of a four-part series, sets the stage for ongoing discussions on building resilient and agile organizations capable of thriving amid evolving business landscapes.
U.S. stock indices experienced gains on Monday, as investors anticipated significant corporate earnings reports and potential trade deals with an August 1st deadline approaching. The S&P 500 increased by 0.6%, the Dow Jones Industrial Average rose 0.5%, and the Nasdaq Composite climbed 0.7%. Notably, Verizon Communications saw a 4.8% rally in its stock price after reporting robust second-quarter profits, while Sarepta Therapeutics faced a 7.4% decline following the FDA's request to halt shipments of its gene therapy due to safety concerns. Additionally, Jack Dorsey's block surged 8.2% as it prepared to join the S&P 500 index. In the bond market, the yield on the 10-year Treasury note decreased to 4.35% from 4.44%, contributing to a rise in gold prices as the dollar and Treasury yields eased. Spot gold increased by 1.2% to $3,390.79 per ounce, while other metals like silver, platinum, and palladium also saw significant gains. Conversely, oil prices dipped slightly, with Brent crude futures and U.S. West Texas Intermediate crude experiencing marginal declines as EU sanctions on Russian oil were expected to have minimal supply impact. These market movements reflect a complex interplay of corporate performance, regulatory actions, and geopolitical factors influencing investor sentiment.
Aero Financial Corp has significantly reduced its stake in Williams Companies, Inc., NYSE, WNBA, a key player in the U.S. energy infrastructure sector, by 45.4% during the first quarter, leaving it with 41,843 shares valued at approximately $2.50 million. Despite this reduction, Williams Companies continues to attract strong institutional interest, with major investors like Norges Bank and Blackstone Inc. increasing their holdings. Norges Bank acquired a new stake valued at $575 million, while Blackstone boosted its holdings by 36.5% in the fourth quarter, now owning 18,954,088 shares, underscoring confidence in the company's prospects. Williams Companies recently reported robust financial results, with a quarterly earnings per share, EPS, of 60 cents, exceeding analyst expectations of 55 cents. The company achieved revenues of $3.05 billion, marking a 10% increase from the same quarter last year. It also announced a quarterly dividend of 50 cents, resulting in a dividend yield of 3.44%. Analysts have generally positive views on the company, with a moderate buy consensus and a price target of $61.77, reflecting optimism about its strategic position in the market. This sentiment is further reinforced by upgrades from firms like Morgan Stanley and Wells Fargo, which have raised their price targets. Williams Company's strong return on equity of 15.95% and net margin of 21.18% highlight its financial health and operational efficiency, making it a focal point for both investors and analysts who remain optimistic about its future growth potential.
Imperial Assets, a prominent player in the digital finance sector, has announced a comprehensive upgrade to its security measures in response to evolving industry trends and increased regulatory scrutiny. This strategic initiative comes as the crypto industry faces a dual challenge of rising market participation and sophisticated cyber threats. The company is enhancing its system architecture and risk framework, focusing on multi-layered authentication protocols and advanced machine learning surveillance to detect and mitigate suspicious trading activities. These measures aim to bolster operational continuity and user trust, crucial elements in maintaining a competitive edge in the fast-paced crypto market. The enhancements include biometric verification, tokenized access, and zero-trust frameworks, reflecting Imperial Assets' commitment to exceeding regulatory standards and setting a benchmark for governance in the crypto finance space. The company has also conducted extensive audits, including penetration testing and code vulnerability reviews, to inform its dynamic roadmap for ongoing improvements. This proactive approach not only aims to protect against data breaches and liquidity manipulation, but also positions Imperial Assets as a forward-looking leader in the industry. The firm's emphasis on security and compliance is further underscored by its efforts to align operations with local laws across its expanding global footprint, ensuring robust protection and fostering investor confidence amid market volatility.
Sanford Bernstein has upgraded its price target for Union Pacific, NYSE UNP, suggesting a potential upside of 27.17% from its previous close, with a new target of $286. This outperform rating comes amidst a mix of analyst opinions, with some firms like Stifel Nicolaus and UBS Group having recently lowered their targets to $248 and $245 respectively, citing various market conditions. Despite the mixed reviews, Union Pacific stock opened at $224.90, with a market cap of $134.37 billion and a P/E ratio of 20.26, indicating moderate investor confidence. Union Pacific's recent earnings report showed a slight miss, with EPS at $2.70 against an expected $2.73, and a marginal year-over-year revenue decline of 0.1% to $6.03 billion. However, the company's strong return on equity of 40.80% and net margin of 27.76% reflect robust operational efficiency. Institutional investors have shown significant interest, with 80.38% of the company owned by such entities, suggesting a solid institutional backing. The company's core business in rail transportation, covering diverse sectors like agriculture, construction, and automotive, positions it well for potential growth, especially if economic conditions stabilize or improve.
WNBA players are intensifying their push for a more equitable pay structure as they negotiate a new collective bargaining agreement, CBA, with the league. During the recent All-Star game in Indianapolis, players wore shirts emblazoned with "Pay us what you owe us" to highlight their demands for a fairer revenue-sharing model, higher salaries, and improved benefits. The players' current revenue share stands at 9.3%, a stark contrast to the NBA's 50-50 split. The league's rapid growth, including a recent $2.2 billion media deal and expansion plans, underscores the players' call for a pay structure that reflects their contribution to the league's success. The negotiations are crucial as the WNBA experiences unprecedented growth, with record viewership and expansion plans. The players' demands are bolstered by the league's financial strides, yet the disparity in earnings compared to their male counterparts remains significant. The average WNBA salary is $102,249, in contrast to the NBA's $13 million. Commissioner Kathy Engelbert expressed optimism about reaching a transformative agreement, yet players remain firm in their stance, with some considering more drastic actions like walkouts if an agreement isn't reached by the October deadline. The outcome of these negotiations could significantly influence the league's future financial dynamics and player satisfaction.
Gries Financial LLC has significantly increased its investment in the Vanguard Emerging Markets Government Bond ETF, Nasdaq, VWOB, boosting its stake by 40% during the first quarter, as revealed in its recent SEC filing. This move brings Gries Financial's total holdings to 57,414 shares, valued at approximately $3.69 million, making it the 23rd largest position in their portfolio. This ETF primarily invests in sovereign debt from emerging markets, denominated in USD, and offers a dividend yield of 5.88%. The increased stake by Gries Financial reflects growing institutional interest in emerging market bonds, which can provide diversification and potential higher yields compared to developed market debt. Other institutional investors, such as IFP Advisors, Inc. and One Ascent Financial Services, LLC, have also increased their positions in VWOB, indicating a broader trend of interest among financial advisors and hedge funds. This uptick in investment comes amid a backdrop of global economic uncertainty, where emerging market bonds are seen as a viable option for yield-seeking investors. The ETF's performance has been stable, with its stock price opening at $64.83 recently, maintaining its position between a 52-week low of $60.90 and a high of $66.65. This strategic positioning by multiple financial entities suggests confidence in the emerging market's potential to deliver returns amidst volatile global market conditions.
Crestwood Advisors Group LLC has increased its investment in the iShares 1 to 5 year investment-grade corporate bond ETF, Nasdaq, IGSB, by 2.1% during the first quarter, as indicated in its latest SEC filing. The firm now holds 175,563 shares valued at approximately $9.19 million. This move is part of a broader trend among institutional investors, with entities like Ameriprise Financial Inc. and Allstate Corp. also significantly boosting their holdings in the ETF. Ameriprise Financial, for instance, increased its stake by 9% in the fourth quarter, now holding shares worth $685.3 million. This trend suggests a growing institutional interest in short-term investment-grade corporate bonds, likely driven by the current economic climate that favors lower-risk fixed-income securities amid market volatility. The iShares 1 to 5 year investment-grade corporate bond ETF, managed by BlackRock, tracks a market value-weighted index of investment-grade corporate debt with maturities between 1 to 5 years. The ETF's stock opened at $52.62, near its 52-week high of $52.77, reflecting a stable performance. Additionally, the fund recently increased its dividend to $0.1943 per share, indicating a slight improvement in its yield, which could be attractive to investors seeking steady income streams. As institutional ownership stands at over 76%, the ETF's popularity highlights a strategic shift towards safer, income-generating assets in uncertain economic times. This trend underscores a cautious investor sentiment, balancing the pursuit of returns with risk management.
Enterprise Products Partners LP, NYSE, EPD, recently saw a slight reduction in holdings by Kayne Anderson Capital Advisors LP, which sold 23,581 shares, reducing its stake by 0.2% in the first quarter. Despite this minor sale, enterprise products remains a significant part of Kayne Anderson's portfolio, constituting 10.2% of its holdings and valued at approximately $463 million. The move comes amidst a broader trend of institutional investors adjusting their positions in the company, with entities like Diversified Trust Co. and Zarity Partners LLC increasing their stakes in recent quarters. Institutional investors collectively own 26.07% of enterprise products. In terms of market performance, Enterprise Products Partners has received positive attention from analysts, with several upgrading their ratings and setting favorable price targets. JPMorgan Chase & Company recently increased its price target from $37 to $38, indicating confidence in the company's future prospects. The company's financial metrics reflect a solid standing, with a market capitalization of $68.14 billion and a P/E ratio of 11.74. However, the recent quarterly earnings report showed a slight miss, with EPS at 64 cents against an expected 69 cents, though revenue exceeded expectations at $15.42 billion, up 4.5% year over year. Additionally, Enterprise Products has increased its quarterly dividend to $0.545 per share, offering a robust annualized yield of 6.94%, potentially attracting income-focused investors.